Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
Soft landing, no landing, what's going on with the US economy? While cuts at the next week's Federal Reserve meeting is the likely course of action, markets have been debating on the quantum of rate cuts. Will it be three 25 basis point cuts? Will it be a 50 basis point cut to start with to front load rate cuts? These are some questions investors have been seeking answers to, and Friday's unemployment rate and NFP was some metrics being used to evaluate this question. Good morning, JK. How do we stand after Friday's NFP and unemployment rate? How have markets perceived it?
Hey, good morning, Swaraj. So, I think one answer that the market was trying to get after the NFP number was whether Fed will go for 25 or 50. And as of now, it looks like status quo, that is 0.25% cut on September 18th. Data itself was quite mixed. Payrolls came lower than expected at 142,000 versus 165,000. The bigger negative surprise was downward revision to the past 2 months, June as well as July, by about 86,000. And this is coming on top of, or rather, I would say, this does not include the annual revisions that Fed or the government will make later in the year. So NFP itself is not good, but unemployment rate was expected to, some people were expecting it to be higher. It did not actually came lower by 0.1%. Wage inflation was also higher. But deep diving into the number, we see that, it's definitely more of part-time jobs that is happening in the US. And even that is coming down. And full-time jobs are actually on the, declining side. So this is not a good sign. But at the same time, the data itself doesn't give Fed justification for going for a big rate cut. So that is why the markets perceive this as a very negative outcome. It's neither too bad that Fed will cut more, nor it is good enough that the market to place fresh risk bets. So that's the reason why you saw markets slumping on Friday as well, particularly on the tech sector, as well as carrying on the same sentiment to the Asian markets. Also, following the report from US, you had key members like Mr. Waller and Mr. Williams of the Fed speak out about the monetary policy. They definitely said that time has come, which means September is confirmed. But at the same time, about the quantum, they're once again, not committal. So they're non-committal based on, they want to see more data. That kind of language is what they have used. Therefore, now, if you look at the market discounting also, it is still majorly for 100% for 25 basis points, but for 50 basis points, it's again back down below 35% probability. Now, why the markets are so risk averse is also not just because of US economy, but also if you look at the Eurozone economy, German industrial production was down massively compared to the last month and well below expectations. The Eurozone GDP number itself was much lower, 0.1% lower than what was expected. And also compared to the previous year, the GDP number was much lower. So the growth scenario in Europe is definitely deteriorating compared to what what the market was hoping for. So that's another dampener. Finally, today in China, we saw the inflation numbers come substantially weaker, in the sense we see CPI number coming lower than expected, and PPI well into the negative territory once again. PPI was at minus 1.8%. CPI year on year came at 0.6 versus 0.7. And also the inflation rate for the month came at 0.4%. So again, when you have such a disinflation in China, it doesn't help the risk sentiment because the commodities are already on a downward path, and if the prices are not going up, which means the demand is much lower. So if you look at it, there's quite a lot of dark clouds about the global economy. The only silver lining what I could see is the GDP number from Japan that came not better than expected, but much better compared to the last quarter, because it was at 2.9% versus contraction of 2.4% that was seen previously. And on the quarter-on-quarter also, it was plus 0.7% versus minus 0.6. Expectation was, of course, slightly higher. And importantly, even the private consumption has gone up. So if you recall the updates in the last week which we made, the Japanese government has actually upgraded the economy for the first time after several quarters. So to repeat, it is Japan which is a silver lining, but at the same time, again, people are skeptical about it, because if Japan is expanding better, then you will have more rate hike from Japan, and that's not good for stock market. So as we have seen, stocks took a tumble. Yields have gone down, much below the 1-year lows, and in fact, the 2-year yields have taken a big tumble after trading below 3.70, and also the 10-year is trading exactly at 3.70. These are very strong levels. For it to go down from these levels, we really need a much worse news. And again, so either way, if it goes up, that means something rate cut quantum is going to be not so much. If it goes down, that means there is much more bad news from the economy. So either way, I think risk sentiment is not getting much of a support. While I have already told you about Europe and China being on the negative side. On the currency, if you look at the dollar index, once again got a good support at 100.50, and the news from Eurozone being not good is not helping the dollar index, is not helping the single currency to maintain its recovery. So we saw a bounce in the dollar index towards 101, not a very strong bounce compared to it, but then a solid support has been seen at 100.5. So expect dollar to remain supported at these levels. Also, let us not ignore the fact that last week Trump gained a few points over Harris in the polls, and some of his recent statements have been making people aware that if he does come, there's going to be a lot more volatility in the policy as well as in the markets, because in some of the reports, Mr. Trump is reported to have said that he will impose 100% tariff on those countries who ditch the dollar, who diversify away from dollar. So these are very, I would say, may not be a very policy oriented thought or expression, but definitely that gives us a reminder that if he comes back, then we will have a very drastic approach to the policy. So that's why the market should be very cautious, and they wouldn't be selling off the dollar at the low levels. So dollar remains supported. On the dollar rupee, India finally caught up with the global negative sentiment, and we had a big fall last week, almost 1.5% fall in the stock market, and it does look it will still have a negative opening today also. So ultimately, even the valuation and the global sentiment is catching up with India, although not so much reflected in the flows. Flows have been still okay. We still have had more than 2 billion inflow for India the last week. So we did have some flows for the bond market, which made up for some sell-off in the stocks as well. So, but anyway, 85 is being very strongly protected by RBI. But at the same time, let's remember that we are not even going below 85 even when there are inflows. So if there were to be a very strong negative news from the global markets, subject to the RBI being aligned with it, rupee can weaken more than 84. Downside remains very solid. So right now, 83, 85, and 84. That should cover it. Thank you.
Thank you, JK. And of course, Friday's theme was highlighting how the global economy continues to struggle, starting with the job market from the US. NFP saw the downward revision for the previous data, which was not good news for the job market. And delving deeper into the unemployment rate, it seems full-time jobs have taken a hit, but it saw some compensatory effect from the rise in part-time work. Even prominent Fed members agreed on a rate cut in September, but the quantum seems to be debatable. Eurozone GDP numbers were lower, Chinese inflation numbers were lower, even PPI showing disinflationary trend. So the Chinese economy continues to struggle. Japan was the only silver lining, with the Japanese GDP expanding at a good pace. For currencies, dollar index was well supported as weaker numbers from Europe did not help the euro hold on to gains. And in India, of course, the stock market fell in line with the global equity sentiment. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.